A crash of the commercial real estate market is one of the most likely causes of an economic recession in 2024, which could in turn lead to a downturn in the U.S. housing market. In today's video, we're going to look at the latest data for the commercial real estate market and which indicators will be key to watch to gauge when the collapse is upon us and how bad it could get. Let's get into it. The commercial real estate market is made up of several property types: office, multifamily, retail, and industrial properties, which make up the bulk of the market. To start off, let's look at where things stand for each property type, and then we'll look at the indicators that will let us know how bad things are and if a crash is imminent. Vacancy rates are a good metric to gauge the health of a given property type. For the industrial market, things aren't looking too bad. While the vacancy rate has been on the rise over the last year, it is still below where it was before the pandemic. Retail properties are also doing quite well on average. The availability rate has maintained its multi-year decline despite the brief bump at the onset of the pandemic. The vacancy rate for multifamily rental properties, mostly apartment buildings, is at the highest it's been in recent years, but isn't too much higher than historical averages. A lot of this has to do with the new supply that has come online in the last year or so. Nothing too crazy. Here's where a lot of the problems are. Office properties. The vacancy rate is well above historical averages and shows no sign of reversing course yet. This shouldn't come as much of a surprise for most of my viewers. The work from home phenomenon that started during the pandemic has done a lot of damage to the office property market. With vacancy rates so high, property values are on the decline. Many properties are now valued less than the loan to finance them, putting sellers and lenders in a tight spot. When sales are happening, some are seeing massive discounts from previous valuations. Some property owners are giving up entirely and just handing the buildings over to the lenders. The big risk here is that commercial real estate lenders, which are mostly smaller regional banks, can become insolvent because of the large losses they can face on the loans for these properties. If these banks go under, we could face a loss of confidence in the financial sector. Like what happened with Silicon Valley Bank last year, a panic to withdraw funds could make the situation even worse for more banks as deposits dry up. Consumers may pull back on discretionary spending if sentiment takes a turn for the worse, and businesses could struggle if lending standards tighten up significantly. No one really knows for sure how all this could affect the overall economy, but there's definitely the potential to send us into recession. That recession isn't here yet, however. The labor market is still adding jobs and gross domestic product is growing at a robust pace. But we can look at commercial loan data to see if things are taking a turn for the worse. Here's a graph of commercial real estate loans at commercial banks. These loans are primarily for commercial mortgages, and at first glance, things don't look too bad. Loans are still being issued and loan levels are actually at an all-time high. This is a bit of a lagging indicator, however. Looking back at the financial crisis in 2008 and 2009, commercial loan levels didn't start falling off until the recession was well underway. Another loan metric to watch are commercial and industrial loans. These loans can be used for working capital or capital expenditures like purchasing machinery. Here we're seeing some problems forming. Outside of a recession, the total loan level generally trends higher over time, but now we're seeing a very noticeable sideways trend and gradual decline. The fact that we're not seeing it head sharply lower suggests we aren't in the midst of a collapse right now. Perhaps one of the most important loan metrics to watch is the delinquency rate on commercial real estate loans. This gives us a sense of how many borrowers are stopping payments on their loans. The delinquency rate on commercial loans excluding farmland that were booked in domestic offices stood at 1.2% as of the fourth quarter of 2023, which was the highest rate since the second quarter of 2015. It has certainly been on the rise lately, but when we step back and take a longer view, we see that this rate peaked at 8.9% in the first quarter of 2010 during the financial crisis. So we are still a long ways off from historical danger levels. Overall, the loan data is showing us that there are some problems in the commercial market, but we are not in the middle of a collapse right now. We likely have several more months before we start seeing additional problem signs showing up in the data. But the consensus view is that trouble is definitely on the way. Even the Fed Reserve is not trying to sugarcoat the situation. Part of their job is to calm the markets. Recent statements by Fed Chair Jerome Powell acknowledge the pain is on the way, although he thinks some bank failures will not pose a risk to the overall system. This is my first video where I'm digging into commercial real estate market and financial data, and I'll be releasing updates in the months to come. If you want to get an objective assessment on the situation and not just a bunch of hype and speculation on where things are headed, make sure you subscribe to the channel and hit that notification bell down below, so you know right away when my next video on this topic comes out. And if you like today's video, don't forget to hit that like button on the way out to support the channel and help it grow. Thanks for stopping by. I'll see you in the next video.